Hello everyone, welcome to today's show. After a super electoral year, what should we pay attention to in 2025? As we are in Trump 2.0, how will global economy and trade perform this year? Today we invite Brian Coulton, Chief Economist for Fitch Ratings, to join our discussion. Hello Brian, thank you for your time today.
Yeah, sure. Yeah, hello everyone. It's good to be back.
As we are at the beginning of 2025, would you like to go over the global economy in 2024 first?
Yeah, I would say that it was a year that turned out quite a bit better than expected for the world economy. We had global economic growth of about 2.8%, which is more or less in line, if anything, slightly above the long run average. The biggest surprise was really on the US economy, which proved to be a lot more resilient than we and most forecasters expected. And I think couple of key drivers there. The main one was that just the US consumer remained a lot more dynamic in terms of their spending patterns than we had anticipated. We were expecting a gradual slowdown in consumer spending and just didn't really materialize. And that I think was the main factor. It was partly explained by some very big upward revisions in the third quarter. The US statisticians looked at the numbers again and found a lot more household income growth than they had previously estimated, and that basically painted a picture of a household sector that was a lot more resilient than we'd expected. The saving ratio was revised up, household income growth and the level of household income revised very significantly. So that was a positive surprise. The European economy remained sluggish, but there were some positive developments in terms of consumer spending did start to improve in the third quarter of the year, and that was sort of in line with what we expected, because we saw that real wage growth was recovering. European consumers have been hit very hard by the rise in inflation in 2021, 22, partly related to the energy price shock. But headline inflation has come down quite sharply in Europe over the last 12 to 18 months. And yet wage growth has stayed quite elevated by historical standards. So if there's recovery in real wages, that's led to a boost in consumption, but it's been quite mild, and this comes on the back of a couple of very poor years as well before that in terms of second half of 22 and 2023. So a modest recovery in the Eurozone, more or less in line with expectations. And then, as we've just seen, China did slow down, but we did have some significant shifts in macroeconomic policies in China. From I guess about August, September was when we felt that things really started to shift on the macro policy front, and now started to see some benefits of that in the latest data.
Like you said, China's economy reached its growth target. So how do you comment on China's economy in 2024?
Yeah, no, we'd already started to see some evidence that the policy easing was helping. We saw in November that housing sales on a year-on-year basis turned positive, and we had another positive number for December. And I think that sort of, although it's not going to translate anytime soon to a recovery in housing starts, we don't think, because I think there's a large overhang of inventory, which means that the read through from stronger sales to or stabilizing sales to starts will be delayed. But nevertheless, that pickup was important. But I think the other development is that export growth remained strong, right through the end of the year. Now it's possible that some of that strength is US importers from China kind of getting their orders in before we see what's expected to be a quite significant increase in US tariffs on Chinese imports later this year. So it's possible that there's been some sort of bringing forward. But I think even before the US election result, we were positively surprised by the by the export performance. So I think that's been a big factor. But yeah, we also saw industrial production, and we saw retail sales start to pick up. And I do think that those early signs of stabilization in the housing market that we're maybe now seeing, very, very important for domestic demand in China and broader confidence. And so, it's the domestic picture is looking a little bit better as well. I would say, partly, as I say, that policy easing, which was both on the monetary side, but also on the fiscal side. We see that in the credit numbers, where the local bond issuance has really accelerated in December.
Do you expect Chinese government will release more measures?
I think we do expect a further widening of the fiscal deficit in 2020 in 2025, and we expect further interest rate cuts. A lot will depend, I think, on exactly what President-elect Trump decides to do. We do think it's a question of when rather than if. But the Chinese authorities will probably be looking to see, make an assessment of any tariff changes that we see, what they would do to the economy, and that will probably have some influence on their domestic policy. But I expect they'll be taking some comfort from the latest numbers showing a slight improvement in the economy at the end of the year.
I think Trump's policy not only affects China, but also affects other countries. I know you conduct research on that. Would you like to share some results of your research?
As we're putting together our forecast for growth in 2025, we had to decide what to assume about US trade policy, and our view was that it did make sense to expect there to be a pretty big increase in the US tariff rate. So what we've assumed is that the US tariff rate goes up from, and this is an average for the country as a whole, for the US imports as a whole, the average effective tariff rate is currently about 2.3%. We assumed that would rise to 7.5 to 7.75%. So pretty big increase, 5.5 percentage point increase in that tariff rate. A big chunk of that explained by our assumption on China. We think it's going to be a really big increase in the tariff rate on China. We think for the basket of Chinese exports to the US, which are currently subject to tariffs, which is almost 60% of the total Chinese exports to the US. For that subset, we see the what we call the dutiable tariff rate, the duty rate, rising to about 60%. So that amounts to a 25 percentage point increase overall in the tariff rate on Chinese imports, and so that accounts for about 3.5 percentage points of that 5.5 percentage point overall increase. But we've also assumed that tariff increases are broad-based, so they go up. The dutiable rate goes up to 25% on Canada and Mexico, and 10% on the rest of the world. So, that's quite different to what we saw in the first US-China trade war under the first Trump administration, where there were some very targeted industry-specific measures towards Europe, but it was primarily China alone that suffered the rise in US tariffs. We see a much more broad-based increase this time.
How will the US tariffs influence Europe?
I mean, it will definitely be a negative, and that it comes against the backdrop of domestic growth challenges. The recovery in consumption that I spoke to you about. I know it's definitely coming through in the data, but it's proving already to be weaker than we expected. The saving ratio is rising. So against that backdrop, this is another negative shock. The economy that will one of the economies that will be most affected by that is Germany, and that's reflecting the fact that Germany is a very open economy. Exports are very large as a share of German GDP, and the US is a very important trade partner. Even before any tariff changes, the German export machine was kind of struggling a little bit. We're seeing, some challenges in the auto sector, for instance. And so, it's definitely a negative, and we did downgrade our Eurozone growth forecasts in the latest edition of our GEO, partly because of the assumption of this 10% tariff rate on dutiable tariff rate on EU imports. So, it's not a huge negative. It's not as big. The effect we think will be much bigger on Canada and Mexico and China, because the tariff assumption for China is much bigger, and for Mexico and Canada, their exposure to the US is much larger in terms of their exports to the US are much bigger share of their GDP than is the case for most other countries. So it's not as damaging as we believe it will be in Mexico and Canada, but it is a material negative shock at a time when the domestic economy is looking quite weak.
Do you think Trump's policy will lead the inflation to rise again?
We do think that US tariffs will add to inflation in the US. We don't expect US trading partners to sort of mechanically reduce the price of their exports to offset the tariff increases. That hasn't proven to be the case in previous trade wars. So the burden of the higher US taxes on imports has been borne in the United States. Now, it depends on that could partly be absorbed by US importers or retailers narrowing their margins and sort of limiting the pass through of the higher tariffs to US consumer prices, but some of it will go through to higher US inflation, and we have increased our US inflation forecasts quite significantly in our latest global economic outlook forecast.
If the inflation is rising, will the Fed stop cutting rates?
We definitely think the Fed is going to slow down the pace of monetary easing. So, they started with a big bang, a 50 basis point cut in September. Then they followed up at each of the meetings after that with further cuts of 25 basis points. So, so far they've moved pretty rapidly. We expect them to start skipping meetings because of these upward pressures on inflation and risks that inflation turns out higher than they and most in the market expect. It's not just the tariff hikes that they have to consider. There's also going to be a squeeze on net immigration into the US, which will tighten labor market conditions. And as I mentioned, the consumer spending is holding up pretty well. So that's growing. It's growing nearly 3%, which is faster than US growth potential. So that in itself is a source of a potential overheating. So for all those reasons, we think the Fed is going to be a bit more cautious now about the path they choose to bring interest rates back down towards a more neutral level. We still think there's scope for them to cut rates 3 or 4 times this year. But we think that will be it, and probably most of the impact of tariffs and immigration, it will probably be 2026 that we see that impact coming through more strongly. And so, we don't see the Fed cutting rates beyond this year.
So, how many basis points will the Fed cut this year?
December GEO factored in 100 basis points, so 4 cuts. So every other meeting in 2024. As you'd have seen, the last Fed meeting, the messaging that went alongside the cut was less dovish. So there was, some suggestions in the dot plots which the FOMC members set out where they think interest rates will be going. That was signaling more like 2 cuts, and that's sort of in line with what the market is expecting. But those dot plots have not been a great guide to Fed policy in the past, and those projections were put forward before the meeting, and different FOMC members, I think, might make different assumptions about the tariffs. I don't think the Fed is going to preempt tariff policy and sort of make a judgment call or a forecast as to what the tariff policy will be, and then change the path of monetary policy in anticipation of that. I think they will wait and see what happens. It could be some time before we know what's going to happen. So we still think there's scope for the Fed to continue to bring down rates, albeit more slowly, through the course of this year.
Do you think the US economy will still perform strong in 2025?
Well, you've got to remember that consumer dynamic is pretty powerful. As I mentioned, it wasn't just the level of household income that was revised up. The ongoing growth rate is stronger. Uh, the saving buffers look larger than we had previously estimated. The job market is still looking okay. We've got employment growth of about 1.4% year on year. We've got wage growth anywhere between 4 and 4.5%. So, you add those two numbers up, that's pretty decent growth in household income. Household balance sheets don't look in too bad a state. We've had strong growth in the equity market in the last 12 months. That's boosted wealth. So it doesn't look like there's many near-term headwinds on the consumer, and then fiscal policy remains very loose. So if anything, we've got a forecast of 2.1% growth this year for the US. If anything, the risk there, I think, is to the upside, despite the impending increase in tariffs.
How about Europe?
I mean, we do think the European economy is going to see a modest recovery this year, and that's as I mentioned, coming off a very weak backdrop. But we are seeing this pick up in real wages, and real incomes, and the consumer side of things is picking up. The ECB is cutting rates, and there's already some evidence that is leading to looser credit conditions. So we're seeing surveys of bank credit conditions. So how willing they are to lend to corporates and particularly households. The credit standards are easing at the margin, and we're also seeing in the loan growth data things have bottomed out and are starting to pick up. So that's another positive. But the risk, I think, comes from what we're seeing signs of increasing caution among Eurozone consumers. So although their income's picking up, their consumption isn't picking up as quickly. So we're seeing a rise in the saving ratio, or a fall in the share of income that is consumed. That's been quite striking in the recent data, particularly for France and Germany. And it looks as if, given we've had 2-3 years of very sluggish growth now, it looks like the consumers have started to worry a little bit more about their job prospects. We have a European survey of consumers that shows the balance of households concerned about losing their job in the next 12 months has gone back up quite sharply. It's now back up to where it was in late 2022 in the midst of the energy shock. So that's an important downside risk, I think, to our forecast of a modest recovery.
Which country will drive the European economy this year?
Well, what's been interesting in the European growth data over the last couple of years has been the resilience of the so-called periphery. So Italian growth, Spanish growth, the smaller countries, Ireland, Greece, Cyprus, Portugal, they've all been doing extremely well. And it's been the two biggest economies. It's been, well, particularly Germany, that has been struggling. Now, obviously, Germany was hit hardest by the Russia gas shock, and those sorts of severe energy shocks. It takes a long time for economies to recover and adjust to those. So you got to bear that in mind. But it does look as if Germany is the underperformer. Where we see prospects for growth in Spain, have surprised everyone on the upside, and we think that's probably going to continue. Decent growth in Spain. In Italy, we've got some. We've had a big improvement in the share of investment in GDP, and there's still some positives to come there from next generation EU funds and public sector investment. So the Italian growth is not necessarily going to accelerate, but we don't see it falling off a cliff. And it's been better recently than for many years. Whereas in Germany we've had two negative years now of GDP growth. The export sector is struggling. Even before we see any increase in tariffs. So I think Germany is the one that we're all focused on.
The UK is another story. What's your view on the UK economy?
Yeah, I mean, again, you've got to remember it's coming off a very low base. UK growth has been very, very weak we are now seeing interest rate cuts from the Bank of England, albeit at a slow pace, but we expect that to pick up this year. We see 4 cuts from the Bank of England. That's gonna help ease credit conditions. The last budget was led to some sort of modest support for the economy in the near term that was reflected in our forecasts, and that dynamic that we have in the Eurozone of real wage growth now starting to recover is also happening here in the UK. So wage growth is now running significantly above headline CPI inflation. So that decline in inflation, is something that we think will help the household sector. So, we've got a decent pickup in growth. In growth terms, it looks quite good by relative standards. But if you draw the chart of the level of GDP, you go back to 2019, the UK still got a lot of catching up to do. So, we shouldn't get too excited about that 1 year of decent growth that we've penciled in for 2025.
I also want you to talk about Japan, since Japan is in a different cycle. What's your prediction of Japan's economy?
Well, I mean, what we've seen in Japan over the last couple of years is this sort of increasingly convincing sort of reflation story. So, the economy, particularly in nominal terms. So, the combination of real growth and prices. We're seeing a lot stronger growth in nominal GDP. We've seen what's being called as a virtuous wage price spiral emerging. So, the first stage of the reflation was firms increasing prices. The weakening of the yen kind of helped Japanese exporters. They became pretty profitable as the yen weakened aggressively through that period in 2022 and 23, when the rest of the world was raising interest rates aggressively. The Bank of Japan didn't move, and so that divergence in Japanese monetary policy as the rest of the world tightened, led to a strong weakening of the yen. That pushed up prices in Japan, import prices in Japan, but it also made Japanese exporters very competitive, and there was a surge in profitability. But what followed from that is that the Japanese corporate sector was increasingly willing to grant stronger wage demands from workers, and so we've seen a pickup in wage inflation as well. So all those things are feeding through to a positive dynamic with prices going up, that leading to higher wage growth, and that feeding back through to prices. So we've had inflation 2% plus now for quite a long time, and so we do think that means that the Bank of Japan will be happy to continue to raise rates, albeit slowly, and from what's still a very, very low level.
We talked the US, Europe, China, and Japan. Now let's move to the emerging market. How will the emerging market perform this year?
Yeah, emerging market growth has kind of been pretty decent. We haven't seen really sort of strong slowdown across the board in emerging markets. The Indian economy is holding up pretty well. Brazil has surprised everybody in terms of how strong growth has been there. Decent growth in Indonesia as well. So I think big picture is it's a fairly stable growth story. Remember, there was some huge declines in GDP in the pandemic years, and there was some of the expansion that we saw in 2023 was a kind of ongoing catch up from that. I think that force is probably fading now, but the decline in inflation that we saw in the developed countries last year, that was also a feature of emerging markets, and so that's allowed some central banks to start cutting rates. That's not been true across the board. We've had Brazil raising rates very, very aggressively, but that's been a little bit of an idiosyncratic story rather than across the board. So broadly, I would say emerging markets central banks are kind of in in a sort of gradual easing mode. So that's helping, and U.S. growth has been strong, and U.S. import growth has been pretty strong. So that's been helping, but obviously the tariff shock is a factor. There are some countries like Vietnam with a lot of exposure to the US, which are going to be hit by our tariff assumptions. A lot of the Asian economies are very open in terms of the share of exports in GDP. So if we have a shock to world trade because of US trade policy, it is a region where trade matters. It matters an awful lot. And a lot of that trade does ultimately, even if it's not directly exports to the US in terms of consumer goods, it's exports that go to a supply chain through the supply chain elsewhere in Asia first, but ultimately end up in the US. So I think that is an important headwind. The other thing that's been going on as the future path of Fed cuts become more shallow, just as the ECB has been sounding like they've been more and more dovish and going to cut more quickly. That's led to a strengthening of the US dollar, and that tends to be negative for emerging markets. So some headwinds emerging, but nothing dramatic when you're looking at emerging markets as a whole. I don't think not a dramatic slowdown.
Fitch forecasts global GDP growth to slow to 2.6% this year. What's the logic of this forecast?
So what lies behind that geographically? For all I've said about the US economy, we do expect a bit of a slowdown this year. So growth was probably, as I say, 2.75% range last year. We've got that slowing to 2% this year. That's partly because one of the things that was driving growth higher in 2024 was an earlier loosening of fiscal policy. So the government deficit, widened in 23, first half of 2024, and I think that big widening was part of the story that helped growth. We don't. Our assumption is that we don't get a repeat of that, so we see that the fiscal deficit is going to be broadly stable in 25 versus 2024, maybe decline a little bit. So it's the sort of the change in the deficit that matters for GDP growth, and that's got to be slightly less supportive for growth in 2025. But I would say, if anything, the risk is to the upside. But that is mechanically, probably one of the key drivers of the modest slowdown in global growth we have. We do expect growth in China to slow because of the tariff shock. Essentially, it's got to be cushioned by looser fiscal policy, but it's not going to be completely offset. So we got 4.3% growth in China this year, down from the 5% that we just had for 2024. So US and China slowing, Eurozone picking up, modestly, but picking up, and that's sort of that's dampening the slowdown a little bit. So 2.8 to 2.6, not a severe slowdown at all, and 2.6 not that low by the long run historical trend standards.
What potential risks will we face in 2025 besides the US tariff?
We've made a relatively, we think it's a relatively aggressive assumption that we've made on tariffs, but it could be a lot worse. I mean, so as I mentioned before, the assumption we've made is a 60% dutiable rate on Chinese exports, 25% on the dutiable basket of Canada and Mexico export, and 10% on the dutiable rate for the rest of the world. But if those numbers, those 60, 25, 10, if those are applied to all imports from those regions, then we're looking at a tariff shock that's 3 times as big. So instead of the tariff rate going from 2.25% to nearly 8%, go to 20% plus. Now that's, if the increase is on that scale, that would be much more damaging for global growth, and would have a much bigger impact on US inflation, and potentially could move the dial a lot more in terms of the Fed deciding they don't want to cut at all, or maybe even hiking rates towards the back end of the year or into next year. So we just don't know what the tariff policy. So there's a big uncertainty. There's a big uncertainty there.
So do you think the global supply chain will continue rebuilding?
Yeah, I don't think this is not a process that sort of all happens in a couple of years. I mean, but I do think
Yes.
that global businesses will be looking at a more fractured world economy, and they will be looking to sort of insulate themselves against supply chain shocks or big tariff hikes in certain countries. But I think it's a process that takes place at the margin in terms of where does the new investment go, rather than when you build these supply chains over decades, you can't suddenly change the place where you make the stuff. It's just not possible to shift capital resources around that quickly. So I think it's a slow burn process. But yeah, 10 years time from now, they will probably look quite different, more diversified.
I think 2025 will be more challenging than 2024, right?
It certainly won't be boring, that's for sure.
Alright, thanks Brian. See you. 2025 is still a challenging year. It won't be a year of rapid growth. Inflation could also prove tenacious due to possible tariff hikes. This, in turn, will give central banks less room to cut rates. That's all for today's show. Thank you for watching. See you.